Hello everyone, Amit Parekh here from FinstudyClub. We're going to have a quick prep session on fixed income CFA level 1. Fixed income as a section carries 10 to 12% weightage. You simply can't ignore this section. However, the sheer size of this section tends to scare a lot of candidates. All the more reason why you would find this session useful. So there we go. All right. Let's first have a look at the various types of fixed income securities, the important ones that you need to be familiar with. Now, there is this one kind of security where the coupon rate is going to be fixed. So in a fixed coupon bond, you're going to have a coupon which is going to be very well defined. So let's say an 8% annual coupon, $100 5-year bond. This very well describes the cash flows. So I can see that these are going to be my cash flows in year 1, 2, 3, 4, and 5. So this would be a fixed coupon bond. We can also have a floater, and in the case of floater, the coupon is not going to be fixed, but it's going to be pegged to some reference rate. So my coupon could be 6-month LIBOR plus, let's say, 150 basis points. Okay, so if the LIBOR were to go up, my coupon payout goes up. If the LIBOR goes down, the coupon payout would go down. This kind of a bond will have cash flows would be determined by the interest rate movement. To that extent, the interest rate risk in a floater is quite low. In a fixed coupon bond, it is quite high. And of course, it would depend upon a host of things. It would depend upon the maturity, the coupon rate, and the yield. As you would know, greater the maturity, greater the interest rate risk. Greater the coupon, lower the interest rate risk, and lower the yield, greater is the interest rate risk. And I would assume that you guys would be quite familiar with setting up the cash flows of floater. So let's say if we are talking about an 18 months floater where the coupon is set as 6-month LIBOR plus 150 basis points. So this is where the first coupon payment would happen, second and third, 18 months, done. So we look at the 6-month LIBOR over here. So we look up for the 6-month LIBOR over here, let's say it's 4%, then 4% plus 150 basis points, which essentially takes care of the risk premium. 4 plus 1.5, 5.5%. That's going to be the coupon on the first payment date. Depending upon what the 6-month LIBOR is over here, so let's say it's 3%, then 3 plus 1.5, 4.5% is going to be the next coupon payout. So one would know 6 months in advance what is going to be the coupon 6 months down the line. So that's floater for you. In the case of inverse floater, your coupon is going to be some fixed rate minus the reference rate. So let's say something like this, 10% minus LIBOR, 6-month LIBOR. So as you would realize, if the LIBOR goes down, the coupon goes up, isn't it? So the interest rate risk in the case of an inverse floater is going to be the maximum, right? Because it's going to be extremely sensitive to interest rate movements. You would say even the coupon cash flows are going to be quite sensitive in the case of floater as well. But it's just that your interest rate risk is all about how your coupon compares with your interest rate. So in this case, the coupon is going to be by and large equal to the prevailing interest rate, and hence interest rate risk is low or insignificant. In the case of fixed coupon, your coupon is fixed, but your interest rates could vary, and hence the difference between the two could arise. In the case of inverse floater, since the movement of the coupon and the interest rate is in opposite direction, the difference between the two could be potentially very, very high. Hence, the interest rate risk in an inverse floater is the maximum. Let's come to callable bond. Callable bond is the value of a callable bond is equal to the value of a non-callable bond minus the value of embedded call option. Now, we all as investors dislike callable bond, isn't it? Because the issuer can call it back when interest rates go down. That is when you would want to be invested into the bond. But let's say this bond was paying you a coupon, has a life of 5 years, but can be called back at the end of third year, fourth year. So we talked about a coupon which is, let's say, 5%. All right. So let's say interest rates go down and the issuer thinks that it can raise new money at 4%. Then it would have all the reasons to call back this bond. And that's when you would not want to get redeemed earlier than scheduled, because then you would have to reinvest your money at 4%. So as investors, we dislike callable bond. So the value of a callable bond should be lower than the value of a normal bond, and hence the value of callable bond is value of a normal bond minus something and that something is value of the embedded call option. For good reasons, the puttable bond is something that will be liked by the investor, and hence they would have to pay a premium for a puttable bond. Puttable bond is which would allow the investor to place the bond for early redemption, and they would want to place it for early redemption in case interest rates go up, and that's when they would want to retire it early or want to get it redeemed early and then invest their money at higher rates. I think the other thing that's quite important from an exams perspective is the interest rate volatility. Remember, the value of option tend to go up with interest rate volatility. So if there's a rise in interest rate volatility without really no specific commentary on the direction of interest rate movement, then we know that this portion would go up. The value of embedded call option or put option would go up. So interest rate volatility going up would mean that the value of callable bond would come down because this value goes up and there's a negative sign. So net net, your value of callable bond comes down. Value of puttable bond is this plus this. So when this value goes up, your overall value will go up. So you need to set up the relationship between the value of option embedded bonds with interest rate volatility. Moving on, a quick look at convertible securities. This is the easier part in this section. So let me just very quickly take a very simple example to explain all these various definitions. So let's say we have one bond which can be, and it's a convertible bond, and it can be converted into, let's say, two stocks, two shares. And this is currently trading at 1,020. So the face value is $1,000, but it's trading at 1,020. The stock price is currently $450. All right. So that's how things are like. And the coupon payment is to the extent of 5%. So it's a 5% convertible bond. So it's paying an annual coupon of 5%. And in the case of stock, it is apparently paying some dividend, and we shall take the dividend to be $10 per share. So the dividend in this case is $10 per share. So this is how things look like. So let's try and understand these various terms. Conversion value, market price of common stock into conversion ratio. So 450 into 2. So that's 900. Your conversion value is going to be 900. Okay. So that essentially tells you that if today I were to convert this bond into stock, what's going to be the worth? It's going to be $900. The market conversion price is market price of convertible security by conversion. So it's 1,020 by 2, which is essentially 510. So it's almost like telling you that effectively, indirectly, when you buy a bond, you're essentially buying, let's say, potentially two stocks, and your conversion price turns out to be $500. So in a sense, this is some sort of a break-even point. So in case the stock reaches 510, you know that you've sort of broken even in terms of conversion. Market conversion premium per share. Well, we need to look at what is the trading price and what is the conversion price. So you've essentially indirectly paid $60 more. However, do remember this is a convertible option, so you need not really convert it into stock. So there are advantages of having an option. But to think of it, indirectly having bought this stock or potentially having bought this stock, you have ended up paying $60 extra. So that's your market conversion premium per share. It's 510 minus 450. So that's $60. Market conversion premium ratio. Well, instead of finding out the difference, you find out the ratio between the two. All right, so that's premium ratio. Premium payback period. Now, this is interesting, guys. What is the premium that you ended up paying for every stock, in a sense, by buying the bond? You say, hey, $60. Is there any advantage having bought out the bond instead of the stock? You would say, yeah, absolutely. I do have an advantage. In case the stock goes down, the bond price need not go down as much because, as far as the bond is concerned, there are certain cash flows that you are assured of in terms of coupon. And if in case if you don't want to go and convert it, you can always get your bond redeemed on the due date. So there is upside potential by investing into a convertible bond if stock prices go up, and in case stock prices go down, you have some sort of a floor value for the bond because you need not convert it into stock, and you can just hold on to the bond as a plain normal bond. The other advantage is that the kind of income that you generate on bond investment could be more than what you would earn by way of stock investment, because for every stock you earn a dividend of $10. So bond getting converted into 2 stocks, so you would have ended up earning 20, right? Or let's say one bond gives you a coupon of 5%, which is $50. So effectively on one stock you end up earning $25 potential holding on the stock. So you would say, hey, 25 is what I earn effectively on one share, while a real shareholder would be earning 10. I earn $15 extra. So over 4 years period, I would be able to recover the extra that I have paid, the extra premium that I have paid, which is 60 by 15 gives me 4. So 4 becomes the premium payback period. So try and understand it as the number of years you would want to, or let's say you can hold on to your bond and see yourself recover the extra price that you paid for the bond vis-a-vis the stock price. That's how we are going to look at premium payback period computation. The favorable income differential per share is 25 minus 10, which is 15. Premium over straight value, well, I paid 1020. Had it not been a convertible bond, I'm sure it would not have traded at this price. It would have traded like a normal bond, and the straight value of it could have been much lower. So I might just want to see what is the premium that I have paid, or let's say what's the price that I have paid for this conversion option for it being convertible. So this premium, market price of convertible bond divided by straight value minus 1, tends to give you a sense of what's the extra money that you paid for the conversion option. Moving on, we need to see how bond would get priced. How do we arrive at the price of the bond? Well, that's pretty simple. If I have the coupon followed by the face value, so let's say it's a 4-year bond, year 1, 2, 3, 4, I'm going to discount these cash flows with the YTM, isn't it? I can discount it with 1 plus R, 1 plus R square, 1 plus R cube, 1 plus R to the power 4, and add it up, and that's how I would get the price of the bond. Well, I can as well get the price of the bond by discounting not with the YTM, but with the spot rates. So Z1, C by plus C by 1 plus Z2, and Z1, Z2 are all spot rates, and I hope all of you understand what are spot rates. So your spot rates are essentially your YTM for zero coupon bonds. The 1 period spot rate is essentially the YTM of a 1 period zero coupon bond. A 2-year spot rate is the YTM of a 2 period zero coupon bond, and so on and so forth. So one can arrive at the value of a bond by discounting the cash flows with the spot rates. Let us now look at how to value or how to arrive at the flat price and full price. Remember guys, the full price is the fair value of the bond. So that's the price at which you will settle the transaction. It's a fair value of the bond. Your full price minus your accrued interest would give you your flat price. Full price is also known as the dirty price, and flat price is also known as the clean price. Coming over to the question, how would I arrive at the full price? Well, you arrive at the full price as you would normally go about to arrive or to discover the price of the bond. So, which is setting up the cash flows and discounting it with the appropriate rate. If I have a bond which is 2 years, 3 months away from maturity, and it's paying a coupon of which is paying an annual coupon. So this is, let's say, this is where we are. Okay, so 2 years, 3 months. So this period is 3 months. This is 1 year, and this is another year. So that's how the cash flows are like. So you have a coupon which is going to be paid year, and the last coupon was paid somewhere over here. We could have the coupon, we can give a number to it. So let's say your coupon was $10, okay, and you're going to get the face value as well over here. So that's how your cash flows are like. So how am I going to value the bond? I would suggest that you should, to begin with, you should value the bond as if you are over here. So you would have 3 cash flows, 10, 10, 110, and you discount it, and you arrive at the value of the bond. You can easily do it with the help of the calculator. Once you do that, you're going to get the price over here, but that's not the price. The price that you need to arrive at is over here, P star. Your P star is going to be P0 into 1 plus R raised to the power 9 by 12, if R is the effective annual rate, the yield, which has been given to us. So my real price, my full price is going to be P star, which is going to be P0, what you would have arrived at over here hypothetically, into 1 plus whatever is the yield raised to the power 9 by 12. Why 9 by 12? Because 9 months have lapsed, so you compound it to the extent of 9 months. Having arrived at the full price, now how do I arrive at the clean price or the flat price? Well, I would say my flat price is equal to my full price, which is P star minus the accrued interest. Accrued interest is a portion of coupon which is already accrued but has not been paid. Think of it, guys, this $10 is for this entire 12 months. 9 months have lapsed. So 9 by 12, which is 7.5 out of this 10, is the accrued portion. So that's what I need to take out from P star to arrive at what we term as the flat price. Okay, so you first try to arrive at the dirty price and then the clean price. In other words, the full price and then the flat. Coming over to the concept of Z spread. Remember, guys, your bond need not be a risk-free bond. It could also be a risky bond. And in that case, your YTM is going to be greater than the treasury's rates, the treasury yield, isn't it? Okay, so sometimes we try to find out the difference between the YTM of the bond and the YTM of a comparable treasury bond, and look at the difference between the two. The difference between the two might give me a sense of the risk premium. Okay, we term it as the nominal spread. The other way of arriving at spread is to calculate Z spread. So remember, if I have these coupons CCC, C plus face value, so it's a 4-year bond, or let's say a 4-period bond, and we are discounting it with the spot rate, but then this is the treasury spot rate, and this might not actually give you the fair value of the bond because this is a risky bond and it ought to be discounted at a higher rate. So what is the rate at which I should be discounting it? You would say a little extra. So that little extra, let's call it Z, and that's what we add to all the spot rates, and then try and discount the cash flows and see whether it converges with the market price. If it does, then this is known as the Z spread. Okay, let's now look at option adjusted spread. Now, option adjusted spread is relevant for option embedded bonds, which in other words would be your callable bonds and puttable bonds. How would I arrive at the option adjusted spread? My OAS is going to be Z spread minus the option value. Let me spend a minute on it. Why would OAS be the true spread for the option embedded bonds and not the Z spread as we have discussed it earlier? Remember, the callable bond price is going to be lower than the price of a normal bond. In other words, optically the YTM of a callable bond is going to be greater than the YTM of a normal bond. But then this difference is on account of the disadvantage which is there inside the callable bond, isn't it? Because there's a call option embedded within the bond which works against the investor, and hence the investor would pay a lower price, and that might just give us a misleading sense that the yield on the callable bond is more than the yield on a normal bond, which is not the case. This difference apparently between the yield is on account of the cost of option. So may I say the difference between the two by and large captures the cost of the option. So when I look to calculate the true spread, and let's call it option adjusted spread of an option embedded bond, I'm going to look at the Z spread, but I remind myself that that's not the true spread. I need to adjust it for the cost of the option. So if it's a callable bond, your OAS is going to be Z spread minus the option value, which would be in basis points in some percentage terms. And in case of a puttable bond, your OAS is going to be Z spread plus some option value, because this option works in favor of the investor, and hence the true spread is going to be greater than the so-called Z spread. So that's something that you got to remember. Let's look at securitization, or as we would know, essentially there would be the three key parties in securitization. So one is the originator who creates the loan. So the originator would have the loan in its books. These loans are sold to the SPV, and the SPV in turn would give money to the originator, and SPV, to arrange this money, is going to securitize these loans. So these are the loans which were there with the originator, but it sold the loans to the SPV, and the SPV goes ahead and, let's say, issues MBS to the investors, to the institutional investors. Who's going to monitor the loan? Who's going to collect? I think this work is left to the servicer. So generally, it's the originator who tend to be the servicer as well, but then there could be an external entity as well, which agency which could be doing this job and would be collecting some sort of a fee from the SPV. Okay, so that's a bit about securitization. Of course, it's a long chapter, I would say. Again, a quick word on SMM. This essentially tells us the rate at which the borrower is prepaying his or her loan. Okay, and we try to find out the monthly rate. So the monthly rate is arrived at whatever is the prepayment which is being done in the month. So this prepayment is in excess of the principal payment that needs to be done. So let's say in a particular month, the borrower pays $11,000, okay, which we understand that the interest component is $10,000, and let's say the principal component is $500, but he goes ahead and pays an extra, okay, so which is what qualifies as prepayment, principal prepayment, that of another $500. Okay, so we're going to look at $500. That's going to be the prepayment in a given month, and we shall see what was the outstanding principal at the beginning of the month. So let's call it P0 minus the scheduled principal payment in month T, which was 500. Okay, so he has prepaid extra to the tune of 500 divided by P0 minus 500, and this 500 of course corresponds to the scheduled principal payment, and P0 is the principal outstanding at the beginning of the month. Now, quick discussion on duration, and this I should say is extremely important. So there are a couple of definitions of duration that you need to know. One is the Macaulay duration, okay, the other is modified, and then you have effective duration. So Macaulay duration, you set up the cash flows of the bond, you find out the present value of the cash flows. These are taken as the weights. You multiply it with the timing. So year 1, 2, 3, 4, let's say this is when the cash flows happen. So you multiply the weights with the time, and then you add it up, and then you divide it by the price of the bond. That gives you Macaulay duration. Okay, it's almost like the weighted average life of the bond, with the weights being the present value of the cash flows which the bond represents. Okay, so once you find out Macaulay duration, that divided by 1 plus the yield gives you modified duration. So that's a little about modified duration, Macaulay duration. I can as well find out modified duration by looking at the price when the yield goes down. So let's call it P minus the price of the bond when the yield goes up. So we try and stress the price by changing the yield, let's say 1% up, 1% down. So this is when the price is, when the yield is taken a little lower. So clearly this price is going to be higher and this price is going to be lower than the base price. And let's say the base price is P0. So I'm going to find out the difference between the price and divide it by P0 and further by 2, because I need to take the average of this, and then I divide it by the change in yield. So this gives me a sense of approximate modified duration. In fact, we calculate effective duration in the same way. So there we have the calculation for effective duration. The only difference being that in effective duration, you would tend to take the change in yield of the benchmark, while in the case of modified duration, you would essentially take the change in yield is with respect to the concerned bond. So effective duration is something that you can find for option embedded bonds as well, because the change in yield that you are taking into account is not the yield of the bond, but of the benchmark. And that's useful because it's not easy finding out the yield of option embedded bonds. So that's how we arrive at the portfolio duration. So where we take the weights of the individual bonds, and we will have the duration of those bonds. In case if you're wondering what's going to be the weights of the different bonds whose durations are being taken. So if you have bond A, B, C, D in your portfolio with their durations as well known to us, DA, DB, DC, DD, okay, then I look at the value of bond A, okay, the current value of bond A in my portfolio, the current value of bond B in my portfolio of C and D. These would get multiplied. I'm going to add it up and I'm going to divide it by the portfolio value. So that's going to give me the portfolio duration. Money duration is essentially your modified duration into the value of your bond. So if the duration of the modified duration of the bond is 5, and let's say the bond is currently trading at $950, this gives me the money duration. Now, when I multiply this with the change in yield, that would give me a sense of the change in the value of the bond. Okay, so that's what we are talking about. The change in the value of bond is money duration into the change in yield. If the change in yield is exactly 1 basis point, which is essentially 0.001, okay, then it becomes the price value of basis point. Convexity. Convexity, as we see, is the second order approximation. So we look at how would the duration change on account of the change in yield. So that's something that we capture by way of convexity. And your price effect is going to be your duration effect plus your convexity effect. So minus into duration into change in yield plus half into convexity into the square of the change in yield. This is extremely important. Duration gap gets tested very often in the exam. Duration gap is Macaulay duration minus investment horizon. So let me try and explain this. So Macaulay duration is the duration of your asset. So let's say if you've invested into a bond, okay, you need to look at the duration of it. Well, that's the Macaulay duration. Investment horizon is the duration of your liability. So if you look to invest for 4 years, you do it for good reason, right? Because you have certain liability to be paid back at the end of 4 years. So think of it, guys, if my duration gap is positive, that means the duration of the asset is more than the duration of liability. So you bought a 5-year bond, so that when the duration gap is positive, well, we can think of a scenario when you bought a 5-year bond, but you need to sell it. You need to sell it at the end of, let's say, 4 years, because your investment horizon is 4 years. So if this is how things are like, then what is the risk that you are exposed to? You would say, hey, price risk, because I need to sell it at the end of year 4. It's still 1 year left for the bond. I don't know the price at which I would be able to sell it. Okay, so you are exposed to price risk. In case the duration gap is negative, that means if this is 4 and this is 5, in other words, you want to be invested for 5 years, but you've invested into a 4-year bond. So you would sell it after 4 years and reinvest back your money for another year. So there you would be exposed to reinvestment risk. So when your duration is negative, that's where you are exposed to reinvestment risk. And this is extremely important, guys. All right, let's now come to fundamentals of credit analysis. So, quick explanation. Expected loss is equal to default probability into loss severity given defaults, which is LGD. So PD into LGD gives you your EL, and that's quite plausible, right? So if there's, let's say, a 10% probability of default, and given that there is a default, I'm going to lose 40% of my money, then 10% into 40%, 4% is going to be my expected loss. So if I have given $100 each to 10, or let's say 100 individuals, and when I say PD is equal to 10%, so expectedly I expect 10 people to default, 10 individuals to default, and the 10 individuals who would default, then to whom I would have given $100 each. So this, of course, is my total exposure. But then this is the amount at risk. But then I realized that I would be able to recover 60%. That means 40% of it will go bad. So 40% into 100 into 10, which is essentially 400. So which is 4% of your total exposure. So that's how we arrive at the expected loss. Yield on a corporate bond is definitely going to be more than the yield on a treasury bond. The extra spread that it gives is largely on account of liquidity premium and credit spread. So liquidity premium for liquidity risk and credit spread for credit risk. So my yield spread is liquidity premium plus credit spread. So in case if the yield spread goes up or down, okay, my yield as well would go up or down. So similar to the impact of the change in yield on price is going to be the impact of the change in yield spread on price. So there we see the return impact of the change in yield spread is equal to minus duration into the change in spread. Very similar to minus modified duration into the change in yield, but instead of yield we replace it with spread, because spread again is a component of yield, so we can't just take it away. Similar relationship would hold true. Similarly out here we look at the return impact in terms of duration effect as well as convexity effect. So there we come to the end of this quick prep session. I hope it would be useful to all of you. Thank you.